Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings, Charlie. It's always great to have you on the podcast show. I really do enjoy your work, and I recommend anyone, if they're able to follow you. You are one of the unique voices in markets.
Really appreciate that, man. It's always great to see you, and I appreciate all the work that you're doing with MacroHive, and we even just had a little summer run in Copenhagen, by the way, which was a treat.
Indeed.
I'd love to get you back in New York sometime soon as well.
Yeah, definitely. Yeah, look forward to that. I'll let you know when I'm next out there. Now, obviously, lots going on in markets, but maybe we can start with the whole rates move that we've had. So it's almost like since May, June, July, we've had this big rise in bond yields, curve steepening as well, long end driven. So it feels like a real different type of dynamic in terms of the rise in yields. How have you interpreted that move?
There's absolutely a narrative pin the tail on a donkey dynamic here, and I think there probably is some element of death by thousand paper cuts. Without question, the structural stories, untethered fiscal deficit spending, and thus the refunding requirements going forward are absolutely part of this story. Now, is that a treatable thesis in and of itself? No. I mean, part of the dynamic here, and we'll get into the FCI tightening component, which is most critical with the, adding in some, real term premium that we've seen recently. But, I think when there's a positive bond stock correlation, as you have seen in this inflation overshoot regime that's caused global central banks to have to tighten, when you then add in the pure amount of supply that we're, looking at coming down the pipe and in the midst of now, that really is the catalyst for this dynamic. Without question, though, the real escalation point, have been a few flows, right? Where we were tightening again, FCI was tightening again, high for longer became a real base case, and the market started to price that in, certainly over the course of the summer. And what that also too meant was this big FCI tightening impulse, real rates higher, nominal rates higher, was also dragging US dollar in a meaningful way. And that US dollar component, certainly relative to two of the major kind of FX reserve manager players out there, was causing some real pain. And I do think that there, likely were, intervention type flows that were also, complicit, where you were needing to defend kind of local currency against, some really severe, weakening to just kind of stabilize the move at least. But the bigger thing for me, of course, was that with the September Fed meeting, the Fed's kind of shock, I call it the SEP shock, the economic projection shock, that was a de facto rate hike without question, as far as the impact that you've had tightening financial conditions. And, that term premium add, that structural story, plus those flows that we, spoke about. And, I would add one more flow, frankly, while we're at it. Over the course of the year to date at our franchise, real money was a duration buyer. People started the year thinking, the anti-dollar trades. It was the end of the Fed tightening cycle. Everybody was long rest of world, short dollar. The end of U.S. exceptionalism. We were the first to hit the tightening, the end of the tightening cycle and get the slowdown. Well, guess what? It didn't play out. Everybody had their, limbs blown off in that trade. And all of these false starts trying to anticipate a recession that wouldn't realize, ended up seeing buyers of duration really get lit on fire. And ultimately that, there was kind of like a buyer's strike. And the way I was kind of characterizing it to clients over the last month or two into the acceleration of the sell-off was that actually those former buyers of duration became a source of kind of negative convexity in the market, almost like a synthetic short gamma where the lower they went, the more they had to sell. So it was, it was flows. It
And
was
these real money, I mean, would you say they're US real money? Because we know from the sort of data, like lots of foreigners have kind of stepped back a bit. The Japanese, for example,
yeah,
have stepped back a bit. Or
domestic real money,
yeah,
domestic real money for sure. And then also too, like, cash, you kind of had this move, with regards to where you could sit on the curve as a fixed income manager, and moving to very shorter duration stuff. You just lost your sponsorship. Ultimately, it was a big part of this. But the FCI tightening after that SEP shocker, as I like to call it, that was a de facto hike when the market wasn't positioned for that. And that kind of led to this capitulatory sell off that we saw, at peak early last week.
and more generally, many people have been surprised that despite this sharp increase in yields, whether it was a recent rise in yields or the one from going back at 3-4 months, we haven't seen any risk markets blow up. I mean, if somebody told you bond yields would be kind of shoot up to 4.75, 4.8, maybe even go towards 5, you would have thought, some markets would be blowing up, would be in risk aversion. It didn't really happen. I mean, what do you think explains that?
You had equities finally did catch down. You had a
Yeah.
good sell off. The fact of the matter is, and I think we'll probably talk about this later, but you know, when you have 7 names driving 85% and 12 names driving 95% of the S&P return year to date, and all being duration proxies, there is going to be an eventual kind of implication of that. I think the offset has been the fact that you also had this discussion about a higher neutral rate, and the fact that data remained so buoyant and resilient, where it was this sell off, but it was actually increasing people's kind of soft landing probabilities, and people were getting stopped out of hard landing trades over the course of that because the consumer refused to crack, labor stayed tight, wages stayed firm at multi-decade types of highs, even though you were getting signs of that cooling. And that was the Goldilocks dynamic there, where even though, clearly interest rate sensitive parts of the economy have really been struggling, you were getting enough lift from, services types of areas that were, able to kind of stabilize this story. And it was insulating, but without question, the last year was a multiple contraction dynamic, yet you didn't have a crash. It was kind of this grinding repricing of a decade's worth of equities that were largely duration proxies, like we said. You had the recovery this year because people started out over the course of the year thinking that, okay, we're moving into recession. We were going to be seeing some support for fixed income. Well, that didn't happen, but surrogate, you had the AI story, this incredibly idiosyncratic dynamic in those major tech sectors that make up, almost 30% of the index. And, that did all the heavy lifting. That, I mean, literally did the heavy lifting. S&P equal weight is, I think, year to date is, kind of flat to down still. So, that kind of kept things together, even though that in these past few weeks after that September Fed meeting, you did start to see some pretty destabilizing action once the real implications of the tightening kind of hit home. You were I called them the 3 horsemen, right? It was real yields. Crude was part of this backdrop, also idiosyncratic, but typically a kind of late cycle rally dynamic there, late in the economic cycle rally, and in the dollar, and that was kind of acting to pump the brakes, I think. And then you saw that play out in credit spreads. You saw that play out in rate vol, which are poison. Widening credit spreads and higher rate vol are poison from an equities macro factor right now. It's just a lot of sensitivity. So we got equities to finally sell off. You saw the kind of the dollar rally squeeze out, some carry types of trades, and people got, a little bit of a true up there, I guess I would say, with the risk. I think as far as, markets breaking, without a doubt, there's certain sectors that are lugging securities portfolios that have just been absolutely demolished, whether it's, the regional banks, kind of usual suspects, and there's going to be a lot of focus on the regional banks into this, earnings season that's kicking off kind of real time. We've seen a ton of buyers of regional banks vol, in the regional banks ETF or some of those single names, long straddles type flow, which is completely contra to the overall short straddles environment that we've been in. But those areas, insurance companies, without a doubt, lit on fire, just watching this action of the last couple of months of, fixed income, just bleeding and leaking them. People like to talk about risk parity too, to a certain extent. That's overstated. That's almost counter-cyclical, how slow moving their time horizons are. But yeah, I think there's a lot of areas that are leaking and still could act as a source of, challenges ahead. Definitely the regional bank stuff. And of course, everybody continues to realize that, the CRE market is a struggle, to say the least. Nobody's incentivized to see that stuff blow up though. So you get a lot of kind of, kind of renegotiated terms, and you kick the can down the road.
Yeah, no, I mean, it's good points in terms of markets that have broken. It's just that we have the kind of magnificent seven at the top, the Apples, the Microsofts that are kind of masking that's pulling the S&P up. And it kind of looks like, on the surface at least, things aren't as bad as they really are.
One other thing I would add there is that, the playbook in a Goldilocks kind of okay enough growth, but at least currently disinflating type of environment, which is where we're going, from on a 10-year look back, has been, long secular growth, right? Stuff that doesn't need a hot economic cycle to make profits, to beat earnings. And that is mega cap tech. That is FANG. That is these AI stocks right now. I mean, the proof is in the pudding with the earnings of, the NVIDIAs of the world. So, you don't need, so the trade has been long that stuff and short the cyclicals, short the economically sensitives. And it's crushed it of late, because the perverse thing about the economy being more resilient that forced the Fed to have to tighten FCIs so violently is that, yes, rates have moved higher. And right now the Fed is messaging to us that, we've probably done all the work that we need to do, because the financial conditions tightening is going to kind of do the work for them, these seemingly final stages. So the front end is chilling, but the bigger issue has been that as FCI tightens, it only increases the certainty that you get a harder landing or a bigger slowdown, a larger magnitude slowdown. And that's what's keeping like rates pricing, so bimodal, when people, you're so often folks are, looking at, interest rate, short-term interest rate futures, or derivatives and trying to kind of pin the tail on the donkey, saying that, as of, September of next year, we have the first full cut priced. I think the way people need to think about this, that might not sit in that world, is that, this Goldilocks dynamic, this resilient economy that's kind of still holding on, the potential for a higher neutral rate in this new world post-COVID, with all this fiscal spend, obviously still whittling down that, big COVID save, is that, you have this potential that will still be stuck high for longer. But you also, too, because of this really violent surge in financial conditions tightening of late, still have a meaningful, 10, 15, 20 delta tail of a hard stop landing that would necessitate then the Fed not cutting, 25 bips or 75 bips, but the Fed cutting 250, 300 bips. Particularly relative to where we've gone in such a short period of time. You need to see a commensurate cut down if we do hit a hard stop. And that's that bimodal distribution where it's skewing, people's kind of probability distribution. There's just two big lumps out there. It's high for longer, and it's the, we got a problem moment.
That's a really good way of characterizing, actually, because then that tells you that next year's pricing doesn't necessarily tell you the market's base case. it's kind of the average of the two bimodal outcomes. Why they're going to get the hyper long, or we're going to get the crash.
Exactly.
But we're not going to get the
Exactly.
like 50 basis point cuts. It's not going to be that. It's going to be one or the other.
100%. Now, critically, what's happened over the past real, week or so, as we've started getting this turn in this bond rally with a lot of catalysts behind that, is that so many of these trades that have made money, certainly of late, whether it's, short fixed income year to date, which is where a lot of your P&L has been, if you're a macro rates guy, of course, or recently, the steepening, is that you're kind of being incentivized to monetize and take down some of these trades, not only just into year end, but it does feel like the sands are shifting. So like people that have been in, high strike pairs, aren't just now kind of monetizing those and closing those, which has an implication on vol as you close those trades. It has an implication on dealers removing their hedges, which I think was part of that kind of peak capitulatory short gamma flow at the start of last week at the peak of the rate sell-off. But then too, I think, this recognition that, wow, we really just pumped the brakes with a meaningful, FCI tightening. And, a very clear dynamic in markets where lower credit, higher default risk, highly leveraged balance sheets like debt to equity ratio companies getting throttled over the last 2 months, like kind of, as a factor, as an equities factor, like long the top decile of most leveraged balance sheets, short the bottom decile is down like 20%, 2 months. That scared people into thinking like, wow, you know what? Maybe it's time I start taking some shots on receivers here. Like the risk reward got, really skewed on treasuries in light of the magnitude of the sell-off. And I think that too, with those hedge unwinds, with some of the taking off profitable trades, the monetization, and then too, you add in, what's happening right now in the Middle East, further creating this flight to quality bid. It's really seeing a pretty meaningful squeeze, and 10-year nominal yields have gone from 490 plus a little bit ago to down to 450s. So it's been pretty violent, the turn.
Yeah, and I should just sort of timestamp our conversation because this will come out in a few days from now. So it's Wednesday, the 11th of October. This is before US CPI, and this is after the Middle East escalation that we've had. I mean, in terms of how you're seeing this corrective move, I mean, you talked about some of the factors that led to this correction. Number one, I mean, do you think this has further to go? I mean, do you think the rise in US yields is over now? I mean, how are you interpreting the correction that we've seen over the past week or two?
The vibe has changed, I think, is how I started off my note last Thursday, within the rate space. Not only are you seeing those flow shift that I just spoke about, right, from leverage guys that have been, writing shorts and pairs for a long time, tilting into bullish expressions, particularly in the belly, receivers on 5-year tails, duration assets bid in equities, which is leading to this equities bounce. But, I think also too, and this is a point I made in my note this morning, is that, the behavioral psychological shift matters here too, into the year end from like two main players in the market, which is like the people on macro rates. And I made this point earlier, people in macro rates who've had positive performance have been short or in steepeners recently, right? And those folks are being incentivized to monetize these trades, take them off, protect your P&L into year end. It's been a hard year because you've just been this, people have been getting chopped up on kind of macro themes. Simultaneously, real money, who's been struggling, I told you, all those false starts, early on the recession call, that stuff, buying duration over the course of the year and getting limbs blown off. They have been tepid and scared to dip their toes in. And now the magnitude of this rally that we just spoke about, 40 plus, nominal bips here, have been instead, the rally picks up speed. They are acting as a source of synthetic short gamma because they're kind of chasing the rally. So I do think that there is impetus. As always, I think the point that I want to make here is that performance in P&L, particularly into Q4, matters. How much rope do people have to, add new risk? And that stuff kind of matters. That was frankly a big part of, what's happened in equities, the vacuum in equities the last couple of weeks. And we've had a really good call, since August with regards to this window for a pullback, window for a volatility expansion in equities. There's this negative seasonality in that September, October window, which is a function of, huge tax drain. It's the second biggest tax drain prior to the April big federal tax due. But also as well, mutual fund year end is, 31% of mutual fund equity mutual fund assets wrap up in September, October. And that type of dynamic where there's a calendar dynamic, there's a funding dynamic, there's I have to sell securities portfolio to raise cash to pay my tax bill dynamic, that matters. Now, I think what you're seeing in rates is that there's momentum to the other side of this trade. Not saying that rates can't sell off again, but right now, the people that have had this on are incentivized to take profits. And the people that are looking for a winner who maybe from a real money side, need a new quarter or a new month of P&L or a new, fiscal year, are going to be given the ability to then finally chase something that looks a little more stable. It's definitely kind of the playbook too for a lot of overseas, type of real money who will never catch the falling knife. They want to see things stabilize and turn first. And they want to see technicals turn first. And, this looks pretty solid thus far, with regards to the kind of magnitude and sustainability of this move. And I think the longer this stabilization, bleeds, more and more people will feel confident coming out of the bunker and adding to duration. Because again, at the end of the day, the macro thought is that high for longer and FCI tightening this impulsively only increases the risk of a deeper slowdown eventually.
Okay. And we've seen equities bounce as well in recent days. I mean, how do you view that?
We've said that, the duration stabilization was going to be core, the kind of the compression of rate vol was going to be core, and you've gotten that to this dynamic. Not only is it because of what we spoke about earlier, where the durations proxies, the duration sensitives are the biggest part of the index, secular growth, mega cap tech. But also too, the yield move lower is a multiple expansion, kind of catalyst, right? It gives you relief from the recent multiple contraction where these NASDAQ stocks did come off, 10 plus 15, 20% in some cases, during the rate sell-off. But I think too, just as the same way that there was this window for a vol expansion in that, late August, September, October window, or, early October window that did come to fruition. Now there's, bullish seasonalities. You go back to 1970, 1990, it's a very risk-on profile this time of year. Again, a lot of that is start of new, mutual fund year end, and turn into a new calendar year. Fund flows turn very bullish. If you're looking kind of like EPFR historical data, it's more risk on in nature from a sector, industry, factor perspective. All of those things are in the background. And I think that demand overtaking supply dynamic matters here too. Like the biggest months for corporate buybacks are this last part of the year. Right now, this is kind of the last of this window for vol expansion because everybody's in buybacks or everybody's in buyback blackout as you're going into earnings. You release out of earnings over these next couple of weeks, the buyback comes on heavy in November, heavy in December. And, on a, 15-year post QE look back where corporates were kind of incentivized to do, non-economically positive things with all this, cash, but buy back their stocks, bring debt to buy back their stocks. That behavior is still incentivized in the market, and the market rewards big buybacks. So, that helps create this supply demand surge. And then, the final point, and the stuff that's my bread and butter, is the systematic flows. When you get a vol expansion, of that magnitude, kind of going from a, front VIX future 13, just a few weeks ago up to 20, when volatility is your exposure toggle in modern market structure, that just forces a degrossing. It forces an allocation reduction, a risk reduction. CTAs, sold, almost 20 billion bucks of U.S. equities over the last few months. Vol control universe. That's anything from a target volatility to a variable annuity, type of structure. I've sold over, almost 35 billion over the same time period. So now that they have sized down, positioning is cleaner. And I think you have the catalyst for some vol compression into year end with these stabilizing flows, with demand over supply, with the seasonalities. It could get a little squeezy, and I think people are anticipating that Santa rally dynamic to a certain extent too, on top of the macro catalyst being that duration has not just stabilized from the sell-off, but now it's rallying.
And what does this mean for the dollar? It sounds like this would make you bearish on the dollar, or is the dollar not?
Yeah. I mean, I think that the dollar has really tracked kind of yield differentials of late, and real yields, of course, the biggest part of that. And I do think that this is a pretty benevolent environment, and people are dipping back into duration, as we said, some ways chasing back in. So I do think the dollar can settle back. We've seen it on the desk. People looking for expressions to play, China upside, right? Has China hit rock bottom yet? It's hard to say right now. They're obviously continuing to, needle in more and more easing, but, people playing FXI, KWEB, A shares, upside December expirations into year end with all this easing, with the dollar kind of softening. People are looking for ways to express upside and things that are sensitive to the dollar, softening again. So you can definitely see that, that dynamic, playing out. And that's also just kind of like a broad risk sentiment, risk appetite, positive indicator.
And more generally, I mean, what are the things that worry you the most now? I mean, we've had this correction now, and it feels like things are going to start to show reversals from the moves we've had earlier. But are there things as we go into year end that kind of make you think, that I need to keep an eye on because that could spill over and blow up markets?
The if you would have asked me that a week ago, I would have been pretty nervous still. And this is still a credible risk. Some sort of squeeze in overnight repo that could, cause another event. It's been well socialized at this point, the magnitude of the basis trade. But there still is a fair amount of financing that's done outside of, sponsored repo. And, as banks cut balance sheet into, year-end turns, or, from, in the US or Canadian bank year-end turns, and, October, whatever that catalyst for an overnight, squeeze, you could see things get unruly. There's just such a massively leveraged, dynamic in the market. But, to me, I think things just get squirrely tactically, with regards to people maybe thinking that, okay, right now, this reversal, right? Duration stabilizing, equities rallying. It's it's kind of like a positioning readjustment and all those things. Well, as I mentioned before, I do believe that profitability and your trading profitability, and your kind of the VAR that you're afforded, is a dynamic right now. If you can't, if you're in that position where, how crowded but successfully crowded the short and fixed income is, and you keep seeing discretionary macro guys or leverage fund guys, with more to take off, it keeps feeding into that rally. Well, guess then what? CTA trend, which has been legacy short fixed income now for almost 2 years, and it's by far the largest positive sharp driver of their P&L, right, for the past 2 years. All of a sudden they're in a position where months ago it was almost inconceivable to think how deeply in trend. The way I think about this is like kind of, are you in the money or are you out of the money over a 2-week, 1 month, 3 month, 6 month, 12-month horizon? Well, those trends have been so deep because the sell-off in, developed market bonds has been so robust and so consistent. You've just stayed in a 100%, short signal. as this keeps feeding, as this keeps squeezing, say we take a worse turn and with what's happening, the Middle East right now, and there was an expansion of that, and you get an even bigger flight to quality bid, then all of a sudden you're within reach of that very unemotionally executed mechanical, kind of covering that could go down from the systematic space, in trades that have a lot of positioning behind them because they've been the biggest, P&L drivers. Those are the things that worry me where you get this, then you add in, the people that are grabbing because they're underexposed to duration because they had to be underweight duration for, forever. Then you get, convexity hedgers in the mortgage space. You just get, it's classic kind of short gamma. You have to buy the higher it goes. Those are, concerns for me just with regards to the potential for a bigger overshoot than people might realize is possible right now.
Okay, yeah, no, that makes sense. So the risk, if anything, is that the reversal can end up being a trend move rather than just a reversal. And
I
we're
think so.
underestimating
I keep
and
saying like
yeah.
there's two macro tails, and it's very simple to say. Like you either get the hard slowdown that comes sooner than anybody's expected, and at that point, duration is just going to go screaming, or it's this reacceleration of inflation. And there was that picked up a little bit of delta, over the span of the last month where, kind of quarter to date where crude was really squeezing. Well, now crude is cratering, it was particularly even with the situation in the Middle East, it looks like the US is heavily incentivized to see, to cooperate with Saudi. And, you want to see through the Abraham Accords, and keep the OPEC supply cuts. Now there's kind of pressure on that catalyst. US just did a sneaky deal with Venezuela to loosen sanctions just in recent days to just push through, so like crude's coming off, if energy starts coming off again, that tail, that inflation right tail, that could reaccelerate, could see then the market have to scramble back to adding higher Fed terminals, that would be a disaster. But the fact is, I see low probability of that right now, unless you see a real escalation in the Middle East.
Okay, noted. Yeah. So we've covered a lot of ground and we could go on, but I think we've covered the most salient points. I do always, whenever I have you on, do like to ask some personal questions. The main one really is on the health side, because I know you're somebody who is really into optimizing your health. So tell me, what's your kind of latest things you're doing to make sure you're healthy?
That's great. Look, I'm one of those dudes who's like, I was doing paleo for a decade plus, and now I'm, almost exclusively, carnivore, red meat, organ meat, can't eat enough fat, animal fats, butter, raw milk, all that stuff. And that's core and like living this anti-inflammatory lifestyle. Like disease of excess is all about inflammation these days. But with that, I'm going crazy on, NAD and NMM as an NAD, kind of, stimulant. The idea of like hormesis, micro stressing your body is when we become most resilient as humans, both kind of qualitatively and quantitatively, which is why, infrared sauna like crazy, cold plunge, all that stuff.
So you alternate hot cold, like sauna, cold plunge, sauna, cold plunge type things.
Shock yourself. And in the sauna, you want to be running like at least 150 degrees for 30 minutes.
Okay.
Because you get this dead cell kind of clearing event. There's, gosh, I take 50 supplements a day, I would imagine, peptides, red light therapy. I did my first hyperbaric oxygen chamber recently.
So tell me what is the hyperbaric oxygen therapy?
You zip up into a tank and it's like you're going deep sea. Like they slowly pressurize you into this pure oxygen, almost pure oxygen type of environment, and you just kind of flood your body with oxygen. And you come out, they have to depressurize you to avoid like the bends, like I'm a deep sea diver. And you come out and you are, I feel like you get a notable clarity, I'm big into brain maintenance, as we've spoken about before, nootropics and stuff like that. And, that is, it was an interesting add to the toolkit. I don't think like realistically, it's something that I'm going to do every week, but definitely a cool experience. We're just learning so much about, pretty much anything that you've learned with regards to what is purportedly, best behaviors. If you flip those on their heads, i.e. the food pyramid, you're in a far better place. If you completely do the opposite, whether it's sunlight exposure, eating fats, eating animal fats and red meat, all those things, like that's where I am in the spectrum right now.
I mean, what about vegetables then, greens? I mean, do you balance the meat with kind of like broccoli and spinach and, all that type of stuff?
Vegetables are kind of a scam. They're low nutrient value. They are barely bioavailable. When you do get something out of them, you're getting, a fair bit of kind of stress chemical to that kind of makes them less valuable, less bioavailable. If anything, because my wife will kill me, with regards to the kids, like I will eat a small amount of vegetables here and there, again, for a hormetic effect, where it actually, the stress chemicals do create, some internal stress too, and it makes your body more resilient. But yeah, I'm the guy who's
what's a good thing to read on the carnivore diet then? Is there a good book or something? Or
there's a lot of books. There's a lot of
one
books.
Can just look it up.
And honestly, it's like, it's a real time. There's studies, for sure. But there's there are it's an increasing movement for sure. But like the proof is in the pudding for me. My asthma is gone, skin issues gone, joints, in this different world. And I took this wild test called a body phase angle test. It sounds like something about your posture. I took this test at a place in Midtown, a few months ago, and it basically is a measure. It's a test that if you're getting like a ultra high life insurance policy, that actuaries really like as probably like one of the single best, if not the best predictor of lifespan. And effectively what it does is measure in-body inflammation, with regards to your cardiovascular system and, respiratory and joint and all those things. And the output was that, as a 45-year-old, the guy was like double taking. He said, no way. You wake up at 2 a.m, you do this, you work in finance, you commute. Well, this doesn't make sense. But my equivalent age from an inflammation perspective was that of an 18 to 22-year-old. Wow. So, it works for me. Not everybody's the same, but keep fueling the fire.
Right. No, I'll definitely look into all of those things. I definitely wouldn't mind feeling like an 18-year-old again. So, so Charlie, just one final thing. What's the best way for people to follow you?
I come out of the bunker for quality old friends like you, and every once in a while I'll go on Bloomberg, but I try to minimize my public appearances. No Twitter or anything like that from a compliance perspective. It's my note. It's the note that I send, for institutional clients of Nomura Global Markets. There is, as I'm not a member of research, right? I'm trading desk strategy, which puts me in a unique location to be more tactical and more dynamic. It's not quite as long form, but it does give me proximity to the net end trade, and very conscientious again of performance and sharps and P&L and positioning and kind of narratives and things that could tip over where the asymmetries are in the market. If you're a client over a certain kind of revenue threshold of Nomura Global Markets, reach out to your salesperson and we can have you added and start the conversation.
No, that's great. And keep up the good work and good luck for the rest of this year.
Right on, brother. I appreciate that. To you and yours as well.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.